This section B corporate finance, which is 20% of the exam. Test questions will be at levels A, B, and C. The concepts to be tested in this section will be level A and B questions on definition and understanding concepts. Not so much in calculation questions. Part 2 Section B.3. Raising Capital 1. What are the characteristics of the different types of financial markets and exchanges? Different types of financial markets and exchanges have developed around different types of financial instruments, including the following. Capital markets allow buyers and sellers to trade debt and equity securities, including stock markets. Equity buyers sell newly created stock. Primary market, and existing shares. Secondary market, and bond markets, provides debtors and creditors access to buying and selling bonds. Money markets specialize in short-term, less than 1 year, and highly liquid financial instruments, such as CDs, US T-bills, and commercial paper. Commodity markets related to trading commodities, gold, oil, rubber, corn, etc. Derivatives markets manage financial risks such as options, swaps, futures and forwards. These markets are a subcategory of the underlying asset. Stock options trade on stock markets or commodity future trade on commodity markets. Insurance markets allows parties seeking insurance and insurers to negotiate deals to transfer risk. Foreign exchange currencies are traded on this market with different currencies. No central exchange exists, but made over the counter on a small number of banks. 2. What is the concept of market efficiency, including the strong form, semi-strong form, and weak form of market efficiency? Market efficiency refers to the degree to which market prices accurately reflect the true value of investments based on all information. The 3 different levels of efficiency are strong form, semi-strong form, and weak form. Strong form and private information, meaning no investor has an unfair advantage over the average investor. Semi-strong form, the current price for all public information. Weak form, the current price for security accounts for all past price information. 3. What is the role of the credit rating agencies? Assess corporate, governmental or personal debtors' credit risk, or the ability to repay debt as contractually obligated. The debtor's risk is reflected in the interest rate of the debt security demanded by the market. 4. What are the roles of investment banks, including underwriting, advice, and trading? Investment banks serve as intermediaries for financial transactions. Underwriting services raises capital for a firm by placing securities on its behalf. Usually through a IPO. Advice advises clients on numerous financial topics: pricing, fundraising strategies, mergers and acquisitions, wealth management, etc. Trading executes security transactions. 5. What is an initial public offerings, IPOs? The first issuance of the stock of a private company made publicly on the stock exchange. 6. What are subsequent, secondary offerings? Sale of the shareholders' existing shares on the stock market. 7. What is lease financing? Explain its benefits and disadvantages, and calculate the net advantage to leasing using discounted cash flow concepts. Lease financing is the contract in which 2 parties agree to exchange the use of an asset. Can be operational lease and/or capital lease. Advantages: payments spread out over time. No risk of ownership, which allows for possible upgrades during the lease. Does not increase liabilities on the balance sheet. Disadvantages: more costly than purchasing the asset. Misses out on tax treatment. Sec 179 deduction, NAL. Net advantage to leasing. Compares the PV of cash flows under leasing compared to borrowing to own arrangement. Used for operating leases. Positive NAL indicates leasing as a more advantageous option. Steps include cost of asset, Subtract PV of after-tax lease payments, subtract the PV of the depreciation tax shield, add PV of after-tax operating costs, and subtract PV of the after-tax salvage value of the asset. 8. What are the different types of dividends, including cash dividends, stock dividends, and stock splits? Dividends are payments that a corporation distributes to its shareholders. Cash dividends set amount of cash per share owned. Stock dividends company issues additional shares of common stock. Stock split corporation issues stocks after splitting 2-to-1 stock split. Most common. It increase the number of outstanding shares and lowers the price to make it more affordable to investors. 9. What are the factors that influence the dividend policy of a firm? Guidelines as the frequency with and degree to which dividends are distributed. Reflects the board of directors' views and attitudes. Determination of dividend policy includes tax factors, legal factors and financial factors, stability of earnings, opportunity cost, firm's stage of development, signaling, control of the firm. 10. What is the dividend payment process for both common and preferred stock? Board of Directors determines whether to issue dividends, leading to declaration date. Ex-dividend date is the date in which new investors are not eligible for a dividend. Holders of record date is a date set shareholders will receive a dividend. Dividends are then paid out on the payable date. 11. What are share repurchases and explain why a firm would repurchase its stock? It occurs when a company buys back as treasury stock, in order to have more shares available to use as equity incentives. They may purchase them if they are undervalued to see if it can increase over time. 12. What is insider trading and why is it illegal? Buying and selling company stock from individuals who have information that have access to confidential, non-public information. Illegal insider trading is when corporate insiders use this information that is significant and not available to the public and provides an unfair advantage to the public. This concludes the section on raising capital.